Okay, let's just say you have sold your successful company or some real estate and you are expecting a large sum of money. This money is crucial because you need to live off it for the rest of your life, right? And here's what happens. You invest all the money, let's say $500,000 at once in mid 2007. You are excited and waiting for your first returns. But then suddenly you turn on the news and everything seems to be melting down. Your portfolio takes a 41% hit in just 1 year, and your $500,000 has dropped to $295,000, and you might be considering pulling out all of your money. And this, my friends, is one of the biggest risks and fears most investors face. With the stock market at an all time high and many YouTubers predicting a big crash and increased volatility, what's the best investment strategy to handle the situation right now? Are you better off waiting for that big market correction, or do you risk missing out on returns if you stay out? This question comes up a lot when I'm talking with clients, and I completely understand the fear as there's often a lot of stake, sometimes hundreds of thousands of dollars, sometimes tens of millions, or even more. A common worry is what if the market crashes right after I invest? So, in this video, we will cover the pros and the cons of investing your money across 4 different strategies, and I will share the approach I favor after 15 years of experience in the financial industry, where I've helped investors grow their wealth smarter and faster so they can live the life of their dreams. I will provide useful facts and important data to show you what has worked the best in the past because I've done extensive research on this topic and it can make a big difference, right? So, after this video, you know what works and what doesn't. When you face this situation, you will have 4 simple options to choose from. The first one is lump sum investing, where you invest, let's say, $500,000 all at once, even if the market is at an all time high. It will look something like this. This investment approach has the following benefits. You will gain exposure to the markets as soon as possible. Historical market trends indicate the returns of stocks and bonds exceed the returns of cash investments and bonds. When markets are going up, putting your money to work right away takes full advantage of market growth. The second one is dollar cost averaging, DCA, where you invest all your available money over time. How you do this is your choice. However, the typical approach is equal size payments over a specific time period, for example, one payment per month for 12 months. So in this example, you invest $41,000 every month, whether the market goes up or down. So the advantage of this strategy is that you put in your money slow and steady. So dollar cost averaging may be for you if you want to minimize the downside risk of a huge investment or take advantage of the market's natural volatility by lowering the average price you pay for shares. And this also avoid the feeling of regret if the market takes a downturn after you invest. The third one is a hybrid version of these two, where you take 50% of the 500k and put 250k in the market right away, and the second 50% you divide it equal over time. And it combines the advantages and risk from the lump sum and dollar cost averaging all together. And then we have the fourth strategy, and that is you wait for a market correction of 30, 40, or maybe 50% and invest all your money right away at this moment. And the interesting part is this. When I ask my clients what they prefer, many intuitively prefer to gradually invest in their money over time because they often believe this approach helps mitigate the risk of buying in just before a sudden market downturn. However, most of the time, their primary concern isn't about missing out on potential returns. But here's something important to consider. What if I tell you that over time, stock markets generally rise instead of falling? That's right, they go up 75% of the time and go down 25% of the time. So, the best way to compare these strategies is to review how each of them grow over the same buying period, right? So here's a chart from 1960 to 2018 showing how DCA performed against lump sum investing in a 60-40 portfolio. You can see the periods where DCA outperforms when the black line is above 0%. And they are far less frequent, right? For example, if you had used dollar cost averaging, the DCA, starting in January 2005 and continued for the next 24 months, it would have underperformed a lump sum investment made in January 2005 by roughly 10%. In fact, DCA only outperforms lump sum when the market is in decline, such as 1974, 2000, or 2008. Does that make sense? An important takeaway is, and you certainly have to write it down, and that is that DCA underperforms lump sum about 80% of the time by an average of 2.7%. And that's a big difference, right? So, what happens if we extend the period to 24 months instead of 12? Let's look at another chart, and here's where things get interesting. Here you see the same chart over a 24-month period. And an interesting fact is that dollar cost averaging underperforms lump sum investing by 7.4% in 86.5% of the cases. And this tells us that the longer you wait, the more negative the impact on your returns. And this makes sense when you consider that the market rises about 75% of the time. But I hear you saying, yes, Maurice, time has changed. What if you are not using a 60-40 portfolio and instead only invest in the S&P 500? Wouldn't that be riskier since you are more exposed to more stocks? What about that? And that's a great question. Let's look at the new graph. This chart shows the period from 1997 to 2022 over a 24-month stretch, where all the money is invested in the S&P 500. So all your money is invested in stocks. And once again, DCA underperforms lump sum in 80.6% of all the months. So the question is, what's the best approach? Based on historical data, lump sum investing often outperforms DCA because the market generally trends upwards. So over the last 30 years, if you miss the best 30 days in the S&P 500, your return would be 83% lower, and 78% of the best days occurred in a bear market. So in my opinion, missing these days is a much larger risk than investing at a risky time. So dollar cost averaging will underperform lump sum investing for most of the time. I always say this: the best time to start was yesterday, and the next best time is today. However, DCA can still be appealing if you are cautious about investing everything at once, especially in volatile or high valuation markets. It all depends on your personal situation, your portfolio, your personality, and your emotions. Only you can decide which strategy is right for you. But what if I told you there's one crucial factor that could change everything? Hold on, because there's something I haven't revealed yet. What if market valuations are extremely high and stocks are significantly overvalued, as we see in today's markets? And that's where the Shiller PE ratio comes in. It measures if stocks are overvalued or undervalued based on historical earnings. A high ratio like today might suggest caution. So, to make sure you don't miss out on valuable insight for smarting investing and stay ahead in growing your wealth, hit that subscribe button. In the next video, we will dive deeper into this crucial question: lump sum investing versus DCA, and how the Shiller PE ratio might influence your decision on entering the market. See you there.